Royle.
Yeah,
Welcome to your social media channels today. How are you today?
yeah, we're really good, and I'm happy to say really busy.
I bet you are. I bet you are. We have a particular topic that we have planned to give you today, but there was an announcement yesterday afternoon, quite pertinent, that we're doing a live stream about that. Do you want to add some comment on yesterday's announcement, the increase in the OCR rate and the potential recession in Q2 2023? What's your take on yesterday's news?
Mm. Obviously, yesterday's news was not great. It wasn't unexpected. The press has been full of what may happen for quite some time. It doesn't lessen the impact, of course. And I think people perhaps need to realise that the last 5 years or so of interest rates have been really, really low. In fact, artificially low. And with the rate rise yesterday, we're actually back to about average for New Zealand over the last 25 or 30 years. That probably not much help if you've just taken out a mortgage or you took out a mortgage a year ago and you were paying 3% and now it's coming up for review. So basic tips, I guess, are we really do need as people to look at our personal spending habits. Maybe the days of going out 3 days a week have come to an end, and we maybe only go out 1 day a week. Looking at our overall loan structure, whether we're with the right lender, whether we're on the right product, etc., etc., and that's really where an advisor comes in, whether it's me or anybody else. Um, the worst thing to do is bury the head in the sand, I think, is my single piece of advice. So if it's going to hurt, an advisor can perhaps make the hurt a little less.
And that's what we're here to talk about today. We have 5 topics that we said that we were going to cover. I'm going to summarize those in just a moment. But if you are joining us on the live and you have a question, please ask your question in the comment section below this live stream, and Jeff or one of the Islander team will come back and answer your question pertaining to it. So the 5 things we said that we're going to discuss today are: I'm self-employed and the bank won't accept my true income. I work overseas and there's some calculator stuff that needs to be mindful of. My bank statements are not that flash. That one is just describing John Mabry's bank statements. I own my own home and want to buy a rental, and something to do with the 40% deposit. Well, that's going to be very pertinent. And there is something about my bank has told me that I can't extend my interest-only period to do with my investment mortgage. We're going to talk about that, but let's start for the first one, which is I'm self-employed. A lot of people are self-employed. A lot of people are going to be worried around their self-employment, and the bank won't accept my true income. What would you say they should do, Jeff Royle?
So, New Zealand is built on self-employment. I believe we have more as per head of population self-employment than just about anywhere else in the world. So I've always found it interesting that our main lending institutions are less than helpful when it comes to self-employed. And you're looking at a person that's never actually had a job in his life. So I fully empathise with those who are of a similar ilk. So looking at the banks, so the banks will look at financial accounts, and we all use an accountant. And one of the accountant's roles is to minimise our net profit, because if we do that, we pay the IRD slightly less. The downside of that is, of course, that the bank looks at the net profit and then they use that figure when they're calculating your mortgage. The other side is that the banks generally will want 2 years of self-employment history in order to enable to make them lend you some money. Now, a lot of people have changed, particularly since COVID, have gone from the realms of employment to self-employment, gone to the bank, gone to get a mortgage, and very sorry, we can't help. So the good news is there are a raft of non-bank lenders, which is the topic of this broadcast, who can help. And there are key differences between the two. So the first one is that with a non-bank lender, they can accept self-employment for a minimum period of 6 months, not the 2 years that the bank requires. And the other one is certain non-bank lenders can accept alternative forms of verification of what you earn. So instead of having financial accounts, your accountant may be quite happy to sign an accountant certificate, which is basically a guide as to what your earnings are and then looking forward to the projected future. That might be backed up with a couple of bank statements and maybe backed up with some GST returns. And interestingly, when a lender asks somebody for GST returns, they're not necessarily looking for verification of income. What they're looking for is verification that you're actually running your business properly. In other words, you've submitted the GST return on time, in full, it's all correct. So it's a sort of, they call it alt doc or alternative documentation to verify that you've got the ability to do what you want to do and not put yourself at risk and obviously put the lender at risk. So for self-employed people, heaps of options out there. And the good news, or the even better news, is they're getting better and better.
Can you give us one example, maybe a client that you've worked with in the past that might have had that particular problem?
Absolutely. We got some local people who bought a house for cash. Lucky them. Probably about 2 years ago, probably $1.5 million home. They only went self-employed, I think it was 6 or 7 months ago, and they wanted to borrow 200,000 to invest into their business. And they went to the bank, and the bank basically said, "Well, yep, we're only borrowing 200,000 against 1.5 million, but we still have to assess your ability to pay, and you've only got 6 worth of trading, can't help."
Got it.
So they came to us, and it went through easy. It's to us, it's what I call a walk in the park application. It just makes sense, and that's the difference between the banks and the non-bank lenders in general. Banks, and it's not their fault, they are very much restricted by rules and regulations. The Captain Sensible has gone. The does it make sense has gone. Whereas in the non-bank sector, it's very much, are we putting ourselves at risk? Are we putting the customer at risk? Does the deal make sense? And as long as you tick the 3 yeses, pretty much it's a done deal.
Number 2 is I work overseas, or my income is derived from overseas, and the bank deduct a huge amount for their servicing calculators. What do you mean by the servicing calculators? Maybe you could explain that in your answer.
Okay, so this is actually quite a biggie. I know we're known as a team of 5,000, but actually team of 5 million. Freudian slip, probably. But the reality is, I think it's something like 800,000 people live overseas. 800,000 Kiwis live and work overseas. And an awful lot of those are wanting to buy something back home. Not necessarily to move back home immediately, but a lot of them buying something here as a bolt hole, as an investment property. Now, if you go to a bank, then what the bank does is, let's say you're living and working in Sydney, and you're on $100,000 a year, PAYE, normal, like a bank employee or something like that. What the bank does is they'll take your $100,000 a year, and then they'll take the net income. So let's say that's 70,000 a year after tax, and then they'll scale that by 20%. So when they punch it into the service calculator to see if they can lend you money, they actually only use 56% of your gross income. Now, that's pretty harsh. And so a lot of the time, a perfectly good application will fail at a bank for no other reason than it doesn't fit that sort of fairly draconian servicing calculator. So again, non-bank at pretty much bank interest rates. In fact, a couple of the non-bank lenders, their floating rates are less than a trading bank, and that surprises a lot of people. So what a non-bank does is they will take 90% of your gross income. So instead of 56%, they will take 90%. Well, obviously that can make a massive difference to the amount of money you can borrow, and therefore it enables you to do what you want to do.
That is a huge difference, 56 to 90%.
Correct.
Wow.
Yeah, and in some cases, if it's Australian derived income, a non-bank lender can take 100% of your gross income as if you were still living and working here in New Zealand.
It just begs the question, why? Why do the New Zealand banks treat it that way?
I think it's called conservatism. Um, and on the opposite side, one of the non-bank lenders, and like all lenders here in New Zealand, the majority are derivatives of their Australian parents. And one of the heads of non-bank lender here said the other day, "We treat Australia as our Western Isle." So they treat it the same as if you were here. And that can make just such a difference in what you want to do.
Bank statements. Number 3, bank statements are not that flash and the bank won't assist. What say you, financial paramedic?
Happens more than you think. Bank statements. So bank statements pre-COVID, it was quite unusual to see bank statements that were slightly awry. I think COVID more, what do they call it? Brain fog affected people's habits, and that's to be expected. So we do see a huge number of bank statements where things are not right. So that could be unauthorized overdrafts. That could be maybe one too many trips to the bottle shop. That could be a bit of excessive lotto dabbling. Just a myriad of things. And if you want to upset a bank, that's probably one of the best ways of doing it. So what would happen is a bank would defer. They wouldn't necessarily decline, but a bank would defer an application for between 3 and 6 months in order to get your bank statements in order. So it's not as if you've got any bad credit or anything like that. As far as the bank's concerned, you're not being that sort of financially prudent in your bank statements, and their thought process is, if you're not doing that, then how can you manage a $500,000 mortgage? So what can you do about that? Well, you can wait. You can change your habits, which is maybe not a bad thing, and you can do what you want to do, but you can't do it now. If you want to do it now, then there is a non-bank lender who don't ask for personal bank statements at all. So that sort of takes the problem away. Is there a penalty for that? No. They charge about the same as a bank. They can do residential lending, they can do investment lending. They have a range of fixed and floating rate products. So if bank statements are holding you up, they don't have to.
You are full of great advice, Jeff Royle. So you're saying that a non-bank doesn't need to ask for bank statements, whereas you'd kind of want to be prudent, wouldn't you, in making sure that you can actually service the loan. But that's great if you've got a KFC habit or a handbag buying habit, and you still want to buy a home, right?
Absolutely. And we have been through 2.5 years of uncharted, unbelievably stressful times, and people do silly things. We're all guilty of it in uncharted territory, and then to penalise someone for that when they can clearly demonstrate the ability to pay, I just think that's a bit rough. So it's just another example of the flexibility of non-banks in that they can adapt, they can change quickly to the new lending environments, to different situations, mainly because obviously they're nowhere near as big as the banks, and they're not sort of hand-tied by so many of all the rules and regs.
If you are watching this live stream and you have a question, please put your question below this video wherever you might be watching it, and Jeff and the team will come back and answer it. We are up to number 4, and it says, I own my own home and want to buy a rental. The bank wants 40% deposit equity. for the rental purchase, and I have only 20%. What's your answer on that one?
Very common. One of the best selling, if that's the right expression, products outside of mainstream banks is the investment property where it's linked to your home. So if you go to any bank and you say, right, I've got my house in Auckland worth whatever it's worth, and I've got this mortgage, and I want to go and buy a rental property in Hamilton, the bank will say, cool, no problem. So they look at your owner occupied, and they will go up to 80% on that, and they will look at the rental property in Hamilton, and they will go up to 60% on that, where it's in an existing property. New builds are exempt from these rules and regs, but let's concentrate on the existing property because that's where most of them go. So then, oh dear, very sorry. You can afford it. The rental income's great. However, Gerald Reserve Bank have said we can't lend to you because you're asking us to lend more than the speed restrictions allow. So again comes the if you like the knight in shining armor in the form of a non-bank lender, and what they say is as long as they have your owner occupied property, you can have 80% on both properties. And of course, that can make a massive difference to the ability for somebody to purchase. Interest rate wise, again, floating rate is the same as a bank. Fixed rates are a bit more. But at the moment, I think floating rates are having a bit of a resurgence because it does allow people to make overpayments. And if you go into interest only, you can actually use overpayments in place of having a principal and interest loan. So that comes into the loan structure, and that's sort of a fairly important part, but that's a bit down the track. So the nub of it is banks, 80% on your owner occupied, 60% on your rental, non-bank, 80% on both.
Sounds like you're the knight in shining armor, Jeff. Last question, last one.
Worse.
I bet you have. The last one is, my bank has told me that I can't extend my interest-only period on my investment mortgage, forcing me to take principal and interest, and this is putting extreme pressure on my cash flow. Very wordy question to a non-money person. What does that mean?
Well, this is a really interesting one. Banks, lenders in general, are supposed to make sure that whatever they do, they don't put somebody at financial risk. And yet here we have a situation where if somebody's got, say, 3 or 4 rental properties, the bank would have given them, say, a 5-year period of interest only. So this has got nothing to do with your owner occupied property. This is only referring or relating to an investment property. So the first thing I would say is investment property is outside of what's called triple CFA. And triple CFA are sort of the guidelines, or one of the guidelines under which a lender can lend to people. And it's really targeting owner occupation in your own personal name. So a rental property technically is outside of triple CFA. Unfortunately, a lot of banks don't see it that way. So give an example, recently a local couple here, late 60s, they live on their boat, very nice, and they've got 4 rental properties and with a mainstream bank. And the bank said, you come to the end of your 5-year interest only period, we're now going to put you on principal and interest. Oh, and look at that, you're of a certain age, and we're going to cut the term down to 10 years. So that meant that in order for them to stay with the bank, they would have had to sell one of the properties, which they didn't want to do. So they came to us and said, is there an alternative? And surprise, surprise, there is. And it takes the form of up to 20-year term, up to 60% loan to value, and you can have up to 20 years interest only. Now, the interest rate on that product is the same as a bank on the floating rate. So again, we come back to, you can have interest only on the floating rate, And if you choose to make overpayments, then you can. So you can become, if you like, your own driver in reducing the debt or not. So in this particular case, it meant that they could continue living on their boat, they can continue to own the 4 properties they've got, enjoy the rental income and the longer term property growth, and it protects their retirement plans. So great product, incredibly well used at the moment, particularly as a lot of the banks are just tightening and tightening. So yes, for seasoned investor, and it is an investor product, it's absolutely a fantastic solution to a problem that actually shouldn't be there in the first place.
Great example. Great example. So when the bank says no, you go to a non-bank lender, and all the advice and all the knowledge comes from this good-looking man, Jeff Royle from iLender. Last comment, just if the people came in halfway through, your recommendations around the announcement yesterday, just to recap on what they should do.
I think the thing is, don't panic. It was a shock, but it shouldn't have been a shock because there's been an awful lot of press around it. I think now is the time to really take stock. Where am I? Where do I want to go? And what have I got to do, if anything, to change it? So it's just making sure that we're not living beyond our means. I don't like to be the harbinger of bad news, but I don't think we're at the top of the rate curve yet. The Reserve Bank signalled very strongly yesterday that there will be more to come in 6 months' time. So planning is everything. And if you feel, or if anybody feels that they're going to get into strife, it's talk to somebody. Talk to your bank if you want to. Talk to an advisor. I always say to people, don't talk to the guy in the pub because he'll probably just tell you what you want to hear. Talk to somebody who knows. And whether you follow that advice or not, obviously that's entirely up to you. Never a good idea to stick your head in the sand. These things won't go away, and if you can plan, you will get through it. And yes, we seem to have a bit of a perfect storm with interest rates and falling property values. But just on that falling property value note, I'd just like to leave you with a little thought. That if we look at August 21 to August 2020, we have seen around about a 15% fall in values. If you look at August 2020 to August 22, we are still seeing a 20% increase in property values. So it's always a question of looking beyond the headline.
Great thing to leave us with. Jeff Royle, thank you so much for your time today. If you've got some value, as I said, put some comments below or reach out to Jeff and the iLender team for any of those questions pertaining to your unique situation. Have a great rest of your Thursday.
Thank you very much indeed.